Hello, everyone. Good afternoon, and welcome to today's event, which is called At Your Professional Service, which is actually one of our fortnightly Master Nuggets with Meng events. So, introducing our wonderful instructor today, Meng Lee, who is a seasoned tax trainer and consultant, specializing in general and corporate tax. Like I mentioned before, Master Nuggets with Meng is a series of fortnightly events that discusses timely topics, all with a case study. So, all very interesting. So, everyone, please give a warm round of applause to welcome Meng today. Yay!
Yeah, good afternoon, Vicky. Good afternoon, everybody.
Afternoon.
I trust everyone's had a good weekend and ready for some interesting issues as we explore today's case study. As Vicky's indicated, if you do have any questions, queries, or comments, or you want some clarification on anything that we go through today, please feel free to post a question in our Q&A, and we'll endeavor to answer as many questions as possible at the end of today's session. So what are we looking at today? Well, today we're actually having a look at the issues associated with allocation of professional firm profits. And this is an issue that's, I guess, close to a lot of practitioners' hearts in that, it impacts their own bottom line. And there has been some controversy and I guess concern amongst practitioners, principally because of the Commissioner's guidelines in PCG 20214 in terms of assessing whether or not, there's risk in respect of a particular firm structure that you or your clients may have adopted. There's also been a lot of confusion amongst practitioners as to whether or not service entity arrangements are still viable, for particular professions. And last but not least as well, we're also going to be having a look at the interaction of, the Commissioner's guidelines on professional firm profits and the PSI rules. There's a common misconception that the professional firm profits rules apply in preference to the PSI rules, and that's not necessarily the case. And the other thing to make very clear is that in a lot of circumstances, when you are conducting a professional services business, whilst the income that you're generating from your business is personal services type income, that income is not necessarily income that falls within the strict statutory tax definition of personal services income. And I think that's something to be aware of as well. Yes, in a professional services business, your interactions and your business often is dependent on your personal relationships with your clients. But that doesn't necessarily mean that the income generated from the business is in fact actually personal services income, because personal services income has a very specific legislative definition. So those are some of the issues that we're going to be covering off today. As I mentioned previously, if you do have any questions, queries, or comments, please feel free to post them in the chat box. Okay, so what are our issues today? Well, we've got 3 questions we're going to be trying to answer. Whether or not the fees received by our entity in our case study constitute personal services income. So we're going to be looking at these issues about what are the factors that the Commissioner considers in terms of determining whether an amount is in fact PSI or not PSI. We're also going to be looking at the Commissioner's views on the concept of PSI in Tax Ruling 20223. Question 2 then looks at the Commissioner's approach with respect to service entity arrangements. And in particular, we're going to be having a look at Tax Ruling 2006-2. You'll all remember that Tax Ruling 2006-2 outlines the Commissioner's views with respect to service entity arrangements, with respect to the deductibility of service fees paid to service entities. And last but not least, of course, we're going to be considering the Commissioner's guidelines in PCG 20214, which of course is the Commissioner's practical compliance guideline dealing with the allocation of professional firm profits. These guidelines, have caused a fair bit of controversy amongst the profession They've also caused a fair bit of concern amongst the profession as well. And the purpose of today's case study is to give everybody a bit of an outline about how you actually practically apply the case study to a particular circumstance, and also to discuss, well, if you happen to be in a situation where you don't get the outcome that you want after applying the test in the guideline, what specifically, or what can you do in terms of managing that particular circumstance? Okay, so let's get going then.
Yep, on to the case study.
Yep.
Ooh.
Okay, so we've got a case study here, and we've got Ray, Jeff, and Dick, who are radiologists, and they each own 33.3%, or 1/3 of a company called KYC Imaging Proprietary Limited. Okay, and they've basically set up their radiology practice through a company, KYC Proprietary Limited, and they each got a 1/3 interest. Now, what's happened, of course, is that Ray, Jeff, and Dick have also set up a service entity, set up Proprietary Limited, so SEDAP Proprietary Limited, and their respective family trusts each hold 1/3 of the shares in this company. Okay. Now, as is common, the service entity, of course, holds all of the plant and equipment that's used in the company KYC. Not only that, the service entity also employs Angela. Angela's responsible for the administration of the business. So she's the one that actually does all the patient bookings, the invoicing, the Medicare claims, the liaising with the referring doctors. So all of that is undertaken by Angela. For those of you who are not familiar, I guess, with how a radiology practice operates, more often than not, what you'll find is that GPs will refer a patient for imaging or some sort of other diagnostic test. And it's the radiology practice, of course, that undertakes that imaging or diagnostic test. And it's the radiologist then, of course, that produce those reports that are provided to the patients and the GP to determine what, of course, is the particular ailment impacting that patient. So a large part of how a radiology practice generates its business is through, interacting with referring doctors. Okay, what else? KYC, of course, pays a service fee to the service entity in return for those services provided. And the amount of the service fee has been calculated as 30% of the gross fees received by the practice. So basically, whatever the gross fees received by the practice is, the service entity receives 30% of those gross fees as a service fee. Okay. What else? KYC occasionally hires locums to assist with the workload. And when either Ray, Jeff, or Dick are on annual leave, the locums generally are paid an hourly rate of about $250 per hour. Okay. So that's something to be aware of as well. What else? Ray, Jeff, and Dick each receive a salary of $200,000 from the company, KYC. The gross fees for KYC in the 2025 financial year was $2 million. And the net profit in KYC after the payment of wages, service fees, rent, etc., was $700,000. Now, the profit hasn't been distributed out of the company. It's been retained in the company. Why? Because Ray, Jeff, and Dick have taken the view that there's going to need to be future plant and equipment purchases. Okay, X-ray machines, CAT scans, ultrasounds are expensive equipment. Like any depreciating asset, they're a wasting asset. So every now and again, you need to refurbish them, etc. So Ray, Jeff, and Dick have said, look, we're going to be leaving that money in the company. And the reason why, of course, is because we want to make sure that we've got sufficient funds to purchase this new plant equipment in the future. Okay. Now, in FY 2025, what's happened, of course, is that each of the family trusts, will receive a fully franked dividend from the service entity. And that, of course, will be funded from the service fee that's paid by KYC to the service entity. Now, because KYC's gross fees in FY 2025 was $2 million, 30% of that is 600,000. So 600,000 has been paid, as a service fee to SEDAP Proprietary Limited. SEDAP Proprietary Limited has then paid tax on that, and then paid basically a $200,000 fully franked dividend to each of the Ray, Jeff, and Dick family trusts. So that's $140,000, in cash, and $660,000 in franking credit, of course. Okay. What else? In FY 2025, the Ray family trust, its only income was that dividend from the service entity, and the trust deed provides that the trust income of the Ray family trust is equal to the net income of the trust, calculated in accordance with Section 95 of the 36 Act. And what's been decided is that the Ray family trust will distribute $150,000 to Ray's daughter. And Ray's daughter is a full-time student and she's not currently working. And the remaining $50,000 was going to be distributed to a corporate beneficiary of the family trust. Okay, so that's the scenario. Now, what are some of the questions? Well, the first question here is this: are the fees received by the company personal services income of the shareholders? Because if the fees received by the company constitute personal services income of the shareholders, then the structure that we've put together is irrelevant. All of that income is going to be attributed to the underlying shareholders, Ray, Jeff, and Dick. Okay, if in fact the personal services income rules apply, this is something that you do need to be aware of. Okay, now, so the first question therefore is in the income received by the company in fact personal services income? The fact that the income is received by a company is irrelevant. Okay, income received by an operating entity can still be treated as PSI, even though it's received by the operating entity rather than the individuals, if we form the view that that income is generated by the personal effort and skill of the individuals, rather than income from a business structure, or income from the use of property, or income from the sale of goods, etc. Okay. Now, the other thing to note, of course, is that the Commissioner's guidelines in PCG 20214 dealing with the allocation of professional firm profits only apply if the income received by the professional firm is not in fact PSI. If the income received by the professional firm is in fact PSI, then PCG 20214 has no application whatsoever. Instead, we fall into the application of the PSR rules, and that's a story for another day. So that's something that you do have to be acutely aware of. Like I said, there's a common misconception that PCG 20214 applies in all circumstances. And that's not the case where you have a professional services business. If it is formed the view that the professional services income is in fact PSI, then PCG 20214 has no application whatsoever. Okay? So having said that, question 2 then is the service fee payable to the service entity tax deductible? Would the Commissioner have concerns about the service entity arrangement entered into between KYC and the service entity? Because as you all know, the Commissioner historically has had concerns about professional services entities setting up service entities, and has had concerns about the deductibility of those service fees paid to those service entities, particularly where the Commissioner is of the view that those service fees are grossly disproportionate or not at arm's length. Okay. Last but not least, if we form the view that PCG 20214 in fact applies to these arrangements, what is the risk zone for Ray with respect to his arrangements in FY 2025? Okay, so let's get started. First question: do the fees received by KYC constitute personal service income of the shareholders? Well, Tax Ruling 20223 provides that income which is generated from a business structure of an entity is not personal services income. Okay, so the law basically says that personal services income is income that's generated from the personal effort and skill of an individual. Okay, but if the income is generated from a business structure rather than the personal effort and skill of a particular individual, it doesn't matter that that income might rely on the relationships that that individual might have generated. If the actual work is done by the business structure or the infrastructure that's put in place, then the law basically says that income is not income generated from the personal effort and skill of an individual, but instead income from a business structure. And because it's income from a business structure rather than PSI, the PSI rules do not apply. Now, tax ruling 20223 then further goes on, well, where income is derived by an entity which has substantial income producing assets or a number of employees or both, the income is more likely to be generated by the profit yielding structure of the business rather than from the rendering of personal services. Okay. And this is relevant here from a radiology practice perspective. Why? Because this is a type of business where there is a significant amount of plant equipment, X-ray machines, MRIs, CAT scans, ultrasounds, etc. As skillful as radiologists might like to think they are, unfortunately, without imaging equipment, unless they've got Superman's X-ray vision, they're not going to be able to conduct their business. Okay. Now, when you're considering whether or not an amount is in fact income from a business structure, the Commissioner in TR 20223 says these are the factors you got to look at. The number of arm's length employees, the existence of goodwill, the extent to which income producing assets of the business are used to derive the income, the nature of the activities carried out, the size of the operation, and the extent to which income is dependent upon a particular individual's own personal skills, efforts, or expertise. Okay, so these are the factors that you often look at. What you'll find more often than not, basically, is the Commissioner's view basically is that, hey, if you've got a business where you've got more employees than you do have business owners, generally speaking, the income generated from that business would be income from business structure rather than PSI. Okay. Now, in this particular circumstance, on the basis of the disclosed facts, it's reasonably arguable that the income generated by KYC would not be personal services income because, as I've explained, there's a sufficient amount of plant equipment used in the business. Not only that, the income's not really dependent on the skill or expertise of a particular individual. Because if you know anything about a radiology practice, more often than not, the patients or even the referring doctors are actually ambivalent as to who's actually going to be producing the report, as long as a report is produced. Okay? And that's the actual, the reality of it. How often have you gone for an X-ray and been concerned about which doctor actually reported on that X-ray? No one cares. And more often than not, the GP doesn't care either. They're ambivalent. So on that basis, you'd be saying the reality is that, the income from this business is not dependent on a particular individual. As long as the reports are done, we're happy with it. Yes, it requires the personal effort and skill of Ray, Jeff, and Dick, but it's not dependent on a particular individual's effort or skill. And in terms of the goodwill, I don't think would be residing in any particular individual either. Okay.
Sorry, Meng, I've just got a quick question here because a few people have mentioned it in the chat, actually. Does it matter that the equipment is being owned by CDAP, which is the service entity, because that's what they pay the service fee for?
No, it doesn't. The question is there a significant amount of equipment actually used in the business? Mm-hmm. So it's actually whether or not a significant amount of equipment is actually used in the business. It's actually irrelevant as to which entity actually owns the equipment. The question, it's a factual thing. Is there a significant amount of equipment used to generate the business? Mm-hmm. Okay. Cool. I'll give you another example. If I'm a pilot, right? Okay. The income that I generate, let's assume that I don't work for Qantas or whatever. I'm a commercial pilot who just works as a contractor. The income that I receive would not be personal services income. Why? Because without a plane, as skillful as I might be, my services will be pretty irrelevant. And so the question is, in terms of the business itself, does the business rely on the plant equipment? Yes, it does. The fact that the service entity is the one that holds the equipment is irrelevant.
Yeah, because you could also be leasing the equipment from some other unrelated entity as well, but you still need to use the equipment.
It's under an operating lease, then you're not really the holder for tax purposes if you think about it.
Yeah.
Okay.
Cool. Thanks, Meng.
Okay, so we've now established that the fees received by KYC do not constitute personal services income. Then the personal services rules are irrelevant. So the next thing then is, okay, we're paying a service fee from the service entity, from the practice entity to the service entity. Now, the Commissioner in Tax Ruling 2062 basically has outlined his rules or his views on the deductibility of service fees. And his view has historically always been that where you've got service fees paid to a service entity, there's a couple of requirements you have to satisfy. Requirement number one, there's got to be a commercial justification for the practice entity service entity arrangement. So you haven't just set this up to split income with related parties. You haven't just set this up to get a tax benefit. There has to be some commercial business purpose as to why it's efficient for you to bifurcate your service entity arrangements and your operating entity arrangements, okay? That's number one, okay? Number two then, okay, the Commissioner then goes on to say, let's assume that's the case. That's actually a commercial reason why you've got a service entity, operating entity structure. The next issue then, which is very important, is the amount of the service fees that are paid to the service entity. The Commissioner in TR 2062 basically says, if the service fees paid to the service entity are between a related parties, so the service entity and the operating entity are related, the actual amount of the service fee, if it's grossly disproportionate or considered to be the Commissioner non-arm's length, he'll take the view, basically, he'll say, well, clearly you haven't, because the service fees are so grossly disproportionate or non-arm's length, clearly you've set this up for a purpose other than just earning income. You've got some other purpose, okay? So yes, we've crossed the threshold that there's a commercial reason why you've got a practice entity, service entity arrangement. But if the service fee that you're paying to the service entity is non-arm's length and grossly disproportionate to what the service entity is actually providing, the Commissioner says that objectively leads me to believe that you're not just doing this for business purposes, you're doing this for other non-tax or other tax-related purposes as well. And on that basis, then, that's the justification for finding basically that a proportion of those service fees is not deductible. So it's not Part 4A. It's not saying you've entered in some sort of nefarious tax avoidance scheme. It's about saying, well, basically, under Section A1, you've got a purpose other than earning income. So therefore, we're going to apportion the deductibility of those service fees. Okay? So for practitioners, the number one issue, if you have a service entity, practice entity arrangement, is to be able to demonstrate to the Commissioner that the service fees that you're paying to the service entity, even though they're between related parties, are in fact arm's length, are in fact not grossly disproportionate to the service fees provided. Okay? But remember one clear thing. Even before you get to the question of whether or not the service fee is an arm's length amount or an appropriate amount to be paid to the service entity, you first have to get across the threshold of proving to the Commissioner that there's a commercial reason for having the service entity in the first place. Because if you can't get across that threshold, the Commissioner will say, you set this all up to get a tax benefit, Part 4A applies, end of story. Whereas, if you get across that threshold, there's a second step you have to get over, which is to be able to demonstrate to the Commissioner the service fee that's payable is in fact arm's length or at least market rates. You know what I mean? So basically what you're saying is, if the service entity was a unrelated party, would the service fee I paid be the exact same amount? You know, it's sort of like using a market comparable. It's almost like domestic transfer pricing, if you want to think about it. Okay. Now, so this, moving right along then. Okay. So now the ATO has published some guidance for medical practice companies. And the ATO has basically said, look, generally speaking, if you are paying a service fee to a medical practice entity, generally speaking, the Commissioner says a service fee equivalent to 40% of the gross fees of the practice is generally appropriate because that's commensurate with the commercial arrangements. So the commissioner's gone out and had a look at some commercial arrangements, etc. And he's basically taken the view that a service entity arrangement where, you've got 40% of the gross fees payable is actually commensurate with, what's in the marketplace. And so he says, look, provided you get across a threshold that you've got a commercial explanation for the service entity, if you are a medical practice company and you're paying a service fee to a service entity equal to or less than 40% of the gross fees generated by the practice, he considers that, generally speaking, to be commercial. However, such a fee is only appropriate, is not appropriate where only limited services are provided to the service entity. So another thing that you need to be very careful about when you're dealing with medical practice companies is not just to assume that this 40% fee is going to be applicable across the board. You actually need to go in and say, well, what does the service entity actually do for the medical practice company? The commissioner says in his guidelines, in order for you to be able to justify this 40% of the gross fee service fee, you've got to be able to show that the service entity is basically carrying on the business. So the doctors working in the medical practice might be the ones that are providing the medical services, but the service entity is the one that does everything else. The accounting, the administration, the collection of invoices, collection of Medicare claims, all of that, remuneration of employee doctors, remuneration of others, the nursing staff, whatever. So they do all the actual business activity, paying the lease, maintaining the plant equipment, all of that, doing the buying the supplies, etc. And the practice company, all it does is basically just run the practice. Okay. Now, if the service entity is only providing limited services to the medical practice, then the commissioner says, hang on a sec, you've got to go back and have a look at that. And you've actually got to go back and question whether or not this 40% is appropriate. So the point of all this discussion is to basically say you have to be very, very careful that, you actually examine the arrangements and don't just assume that this 40% threshold, is going to apply across the board. Okay. Now, the other problem, and this is a problem which has been the subject of a large amount of lobbying from the relevant colleges of physicians and surgeons, etc., is that the ATO provides that medical specialist practices are generally not able to adopt the 40% rate. So the 40% threshold generally only applies to general practices. It doesn't apply to specialist medical practices, like in our case study. So the unfortunate thing is that medical specialists are required to adopt the commissioner's comparable market prices or comparable profits approaches. Okay. And in applying this, anecdotal and unsubstantiated evidence is not enough in terms of providing comparable data. So if your arrangements are to be examined, you couldn't sort of say, hey, that's what, the neighboring business, that does the same thing as us charges, in terms of a service fee. So we should be able to charge the same amount. No, you've actually got to go into the marketplace and say, well, okay, had we actually entered into an arrangement with an actual third-party entity, what would be the amount of the fee? And if the fee that we're paying to our related entity is comparable, then the commissioner will accept that. The problem is it's very hard to go and get that sort of market data because in a lot of circumstances, what you'll find is that the practice entity, service entity arrangements are between related parties, and it's very uncommon for there to be a third-party service entity providing such services. Okay. What else? Now, the other thing is that the ATO indicates that the commissioner will tend to scrutinize arrangements where more than 30% of the combined net profits of the professional firm and service entity is earned by the service entity. So that's another overarching thing that you're going to be very careful about as well, where the commissioner says, hey, when you've got an operating entity, service entity structure, the majority of the profit can't show up in the service entity because that sort of makes the whole structure a nonsense. Why would you carry on a professional services business that's just breaking even, but then you've got a service entity that's making all the money? Clearly that's not a realistic arrangement. And he says basically when you set up a service entity operating entity structure, there's got to be a roughly, at least, a commensurate distribution of profit, recognizing that the operating entity is the one that's generating income. The service entity is providing an ancillary service. And so therefore, it shouldn't be generating the majority of the profit, and that's something to be aware of as well.
Yeah, sorry, Meng, just a quick question there.
Yes.
Is there an actual set definition for what combined net profits means?
No, you just look at
just like gross less
general
expenses.
accounting. It's just general
accounting. Cool. Yeah, okay.
Okay, now, in this particular arrangement, you would consider that it's reasonably arguable that the service entity arrangements entered into by KYC is commercially justifiable. Why? Because there's definitely business efficiencies in having a service entity, operating entity structure, because you want the doctors to be totally focused on just providing the medical services, doing the reporting, and it's efficient to have another entity that's responsible for the administration. From an asset protection point of view as well, it's not a bad idea that all your fixed assets, plant, equipment, if you had real property, is sitting in a separate entity, just in case the actual operating entity gets sued. Okay, so in this particular case here, you say it's reasonably arguable that they didn't do this just to get a tax benefit. Okay, so they didn't just set the structure up to inappropriately split income with related parties. Okay, number one. Now, that doesn't get us all the way across the threshold, however, in terms of determining the deductibility of these service fees. The next question we got to ask ourselves then is the service fee that's paid by KYC to the service entity in fact arm's length? And in our particular circumstance here, it's 30% of the gross fee, so we're under the 40% threshold. Now, if this was a general practice, give us ourselves a tick according to the commissioner. I know that's equal to or less than 40%. That's commercial. We're in a good position. Unfortunately, this is a specialist medical practice, not a general practice, so we can't use the 40% threshold. So just because we're below the 40% threshold doesn't automatically mean that the commissioner would consider that fee at arm's length. We've now got to go in and say, well, hang on a sec. Because the 40% threshold doesn't apply to us because we're a specialist medical practice, we need to then go and look at comparable market data. And so I guess in this particular circumstance here, being conservative taxpayers, it would be prudent here for KYC to obtain third-party evidence to demonstrate that the service fee paid to the service entity is comparable to an arm's length arrangement. Okay, now, the ATO, generally speaking, would probably not be super concerned about this structure. Now, this is only my personal opinion, okay? So it's not anything administrative or anything official, but in this particular structure here, you'd say that less than 30% of the gross profit of the business has ended up in the service entity. So on that basis, you'd argue that, hey, or up to or 30%, not more than 30%, has ended in the service entity. So the commissioner may overall not be as concerned because a disproportionate amount of the profit of the business hasn't ended up in the service entity. Our difficulty here in this particular circumstance, and it's not to give you the answer, but to highlight the issues, is the fact that it's a medical specialist practice rather than GP, so we can't use the 40% threshold. And it's also to highlight the issue that this is the number one concern amongst medical practitioners. And it is a subject of lobbying, like I say, by the AMA and the relevant Royal Colleges of Physicians, etc. Okay. Any questions so far?
We've got a few, but maybe let's finish off the last question because I'm just reading through it. But I'll just say for people who are posting questions in the chat, do you mind popping them into the Q&A just so it's easier for me to sort through everything? Thank you very much. All right, last one.
Okay, the last one. So now that we've established that the income received by KYC is in fact not PSI, the next question then basically is, well, does PCG 20241 apply to these arrangements? And if it does, what is the risk zone for Ray in respect of FY 2025? Now, first thing first, PCG 20214 applies from the 1st of July 2022. And when you're applying this guideline, it's not applied to the practice in general. It's actually applied to the individual professional practitioners within the practice. So you could have a situation where you've got 3 partners in a practice. One of them may actually be in a lower risk zone than the other, depending on their own individual circumstances. Okay? So the guidelines are applied to the individual business owners rather than the practice as a whole. Even though when you're applying the factors to determine risk for each of those individual practitioners, you're looking at the practice as a whole and you're looking at their share of the profits from the practice. But in terms of the application of the guidelines, it's applied to the individual professional practitioners rather than the practice as a whole. That's number one. Number two, PCG 20214 is just a commissioner's guideline. It's not the law. It's not legislation. It's not a ruling. It's a guideline issued by the commissioner, which basically says, in terms of assessing the risk of whether or not we're going to examine your arrangements or whether or not you're going to be subject to an audit or review, this is the document that you're going to use to basically assess your risk. Now, just because you happen to be in a higher risk zone than someone else doesn't necessarily mean that Pathway would necessarily apply to your arrangements. All that the commissioner is saying is that we're more likely to examine your arrangements if you are in a particular risk zone compared to someone else. So this guideline, all it is a tool for practitioners to determine the extent to which or the risk under which their arrangements are going to be examined. Okay? Just because, like I said, you are in a higher risk zone than someone else doesn't mean, oh my God, and I got to jump out of a window. That's not the case. Okay? It's just an indication of the likelihood that the commissioner is going to be examining your arrangements and the likelihood then that you're going to have to actually do a bit more work to be able to demonstrate that your arrangements have not been entered into for the dominant purpose of obtaining a tax benefit. Because the whole basis of PCG 20214 basically is the commissioner says, look, if I've assessed you in high risk and I've actually reviewed your arrangements, you've got to be able to demonstrate to me that you haven't put this structure together for a purpose of obtaining a tax benefit. You've got to be able to show to me that you've got a commercial purpose for putting this structure together, and a substantial purpose for doing this is not to get a tax benefit. Okay? But like I said, it's just a guideline. Okay? Now, PCG 20214 once again has some gateway requirements. One of the gateway requirements is that you've got to have a commercial rationale for the structure that you've got in place. So you've got to be able to demonstrate to the commissioner why commercially this is an efficient structure for your business. Okay? You've got to be able to point to the fact that you haven't just set this up to income split with related parties. You've set this up because there's a genuine commercial reason for doing so. Okay? Now, once you get across that threshold, then the law basically says, well, okay, the other thing that you've got to demonstrate to the commissioner is that your structure that you've put in place doesn't have any high-risk features. Okay, I'll give you an example of a high-risk feature. You might have a structure where you've got a professional practice company where you've got 3 shareholders, but all of their family trusts have access to dividend excess shares, which provide for a preferential dividend to be paid to the family trusts. Now, from a professional business point of view, there is no conceivable reason aside from getting a tax benefit for having a practice company with dividend excess shares. Okay? And that would be something that the commissioner would consider to be a huge red flag, in terms of a high risk feature. Okay? And you'll see on the next slide there, some of the things that, highlight there is a high risk feature. Financing arrangements, relating to non-arm's length transactions, any sort of trust structure where we're trying to exploit the difference between the accounting definition income and the tax law definition income. Okay, where you've had some sort of assignment or transfer of the business of the practice to another entity, So we might have started as a partnership of individuals. All of a sudden now we're a partnership of family discretionary trust. You know what I mean? Why is it that, hey, for 25 years you operated your business as a partnership of individuals and there was no problem? All of a sudden now it's more appropriate to be a partnership with discretionary trust. This is normally, and you only did it, in a particular income year where your turnover was under $2 million, so you could get access to this, you could get access to the small business capital gains concessions. You know what I mean? So this is where the commission has concerns. We talked about it. Multiple classes of shares, multiple assignments or disposals of an equity interest, misuse of the superannuation system, distributing to income to entities other than the practitioner with losses. So you're diverting income from the practice to entities with losses. All of these are red flag things that the commissioner says, well, if you have any of these high risk features, I'm not even going to ask the question whether what risk zone you're in. I'm going to form the view that you've done this for a dominant purpose of getting a tax benefit, and it's not a matter of if, it's a matter of when I'm going to review your arrangements, and you jolly well better have some decent justifications as to why you didn't do this for a tax purpose. So these are the two gateway requirements. You've got to get through these thresholds first before you even look at assigning risk. Okay? Now, once you've got through the thresholds, then the next step is, well, okay, we've established that we've got a commercial reason for having this structure. There's no high-risk features that are going to cause the commissioner concern. Next step then is to say, hey, hang on a sec. What risk zone are we in? So by the assessment of several factors, what risk zone do we assign ourselves? And based on that, we can determine the likelihood that the commission is going to examine our arrangements. Okay? And the factors that you need to consider in terms of determining your risk zone are proportion of profit entitlement from the whole of the firm group returned in the hands of the individual professional practitioner. So how much of the profit from the business ends up in the hands of the individual professional practitioner? Okay? And it doesn't matter if that profit is actually paid to him as salary or wages or as a dividend, but how much of that profit ends up in the tax return of the individual professional practitioner that's basically the business owner and doing the work. Okay? Now, you get a score of 1 if it's more than 90%. If it's between 75 and 90, you get a score of 2. Between 60 and 75, a score of 3. Between 50 and 60, a score of 4. Between 25 and less than 50%, it's a score of 5, and then so on and so forth. Okay? Question number 2 then says, what's the total effective tax rate for income received from the firm by the practitioner and associated entities? So this is where the commissioner says, yes, I know you split income with related parties. Okay? But what's the total effective tax rate? So if we combine everybody's tax rate, what's your average tax rate across the board? And based on that, you're allocated a score. If it's more than 40%, you're a score of 1, between 35 and 42, and so on and so forth. Last but not least, and this particular criteria, you don't necessarily have to apply. But if you do, then it may help you in assigning your risk, is does the remuneration received by the practitioner, to what extent is it a percentage of the commercial benchmark? So there might be a commercial benchmark for salary and wages paid to someone that does a similar thing to the practitioner. Is the amount that the practitioner receiving 200% more than that, or between 150 and 200%? So here's commercial salary for someone that's doing the same thing as the practitioner. How much more is the practitioner receiving from his business? Okay? Because you would expect to be receiving more than what you get as salary wages if you're the business owner and taking the risk. And once again, that's a value is assigned to that. Now, the commissioner has said very clearly to taxpayers, look, factor 3, you don't necessarily have to apply if you don't want to. And the reason why is because oftentimes with smaller practices, it's very hard to find a commercial benchmark. Okay? With a large firm, the ICAA and the CPAs publish data all the time. But with a smaller practice where, it doesn't fit within the box, it's often harder to find a commercial benchmark. So that's why you don't necessarily have to apply factor 3. Okay? Now, after applying all these factors, you then get yourself an aggregate score. Now, let's assume that we just apply the first 2 factors, which is the profits and the effective tax rate. If you have an aggregate score of 9 or more, you are considered high risk. If you have an aggregate score of 8, you're moderate risk. If you have an aggregate score of 7 or less, you are low risk. So how do we distinguish between green, amber, and red? Red basically means that you're considered high risk. The commissioner is probably going to review your arrangements, and you're going to be able to have to provide information to be able to demonstrate to the commissioner that you're carrying on your arrangements, not for a dominant purpose of getting a tax benefit. Amber is where the commissioner will say, well, I may not necessarily commence a review or audit of your arrangements, but I would need more information because I want to be satisfied that you haven't done this for the dominant purpose of getting a tax benefit. Green is the area where the commissioner says you go to the bottom of the pile in terms of risk review and audit. You're low risk. I'm not saying that the rules won't apply to you. I'm not saying that the arrangement you've entered into, Part 4A, won't apply to it. So this is not a blanket safe harbor of any sort. What it is he's saying, look, the ATO being an organization with limited resources, I'm going to allocate it to the red and the amber before I allocate it to you. You go to the bottom of the pile in terms of audit risk. Okay? Now, having said that, how does that apply to our friend Ray? Well, Ray's total entitlement from KYC in the relevant year is $400,000. Now, he's received a salary of $200,000, and the family trust has received a franked dividend of $200,000. $140,000 cash, $60,000 in franking credit. Okay? Now, the family trust has then distributed $150,000 to his daughter and another $50,000 to a corporate beneficiary. Okay? Now, the risk assessment factor is calculated as follows. So, the proportion of profit entitlement of the practice returned in the hands of Ray. So, how much of the profit from the practice has ended up in Ray's personal tax return? Well, that's $200,000 of a possible $633,000. Now, how did I get to $633,000? Well, remember, there was $700,000 left in the company. So we got to pick that up as well. So that's $233,000 there alone, a third of that. There was $200,000 that was paid to the family trust, and there was $200,000 actually paid to Ray. So that's a possible profit distribution of $633,000. Ray has received $200,000 of that as salary and wages. So that's what's ended up in his personal tax return. Now, when you calculate that, that's basically a score of 31%. That's less than 50%. Now, if we go back to the matrix, because that's less than 50%, that's a score of 5. Okay? Now, we then have a look at the next factor. And the next factor then says, well, what's the average tax rate in this particular circumstance? And we've come to the conclusion here that the average tax rate in this particular circumstance is quite substantial, but not substantial enough, unfortunately. And in this particular case here, the effective tax rate is 27.56%. And because it's 27.56%, you get a score of 4. 5 plus 4 equals 9. 9 puts Ray in the high risk zone. Okay? Now, Ray will say to you, he didn't do this for a tax purpose. But unfortunately, based on the application of the matrix, he is in a high risk zone, which means, of course, that Ray will need to make sure that he's got his evidence in place to show that he hasn't entered into these arrangements for a nefarious tax purpose of any sort. Okay? So he will need to basically have his ducks in a row, his documentation in place to be able to show that he hasn't entered into these arrangements for the dominant purpose of obtaining a tax benefit. Just because he's in a high risk zone doesn't necessarily mean that the ATO is going to form the view that Part 4A automatically applies to his arrangements. It just means that he's at a greater risk of review than someone in an amber or a green zone. In fact, he will have his arrangements probably reviewed. Okay? Mm-hmm. But we shouldn't then take the next leap and assume that Part 4A is automatically going to apply. Now, in Ray's particular circumstance, he hasn't applied the third factor. And the reason why he hasn't applied the third factor is, of course, that he says, well, I can't use the salary and wages that we pay to the locums because we pay them above market rates. So that's not commensurate. That's not appropriate. Had he applied the third factor, then his risk rating would be assessed by reference to that third column rather than the second column. Okay. So that's pretty much it for the actual case study. Hope that everyone's been able to get something out of that. And we've probably got enough time for questions. I think about 5 minutes for questions.
Yes, we do. All right. First question I'll take from Matthew, and this is in regards to PCG 2021/4 about the risk assessment factors. So the bit about profit entitlement. Does profit entitlement actually include share of profits that are retained in the company? If yes, what does the PCG say about this?
Well, my understanding is it's not clear, but it talks about the entitlement to the profit of the business as a whole. So even profit retained in the entity would be taken into account. And you can see where the commissioner might be concerned about this, because the profit in that entity is only taxed at, the 25% or 30% rather than the marginal rates of the individual professional practitioner. Because ultimately, this is what it's all about. The individual professional practitioner, rather than being taxed at top marginal rate on the majority of his income or her income, is able to split that income with family members and other entities. So if they were to actually retain that income within the entity itself, that's still an ability to shield that from, tax at the highest marginal rate. So I would argue basically that profit entitlement includes, taking into account the profit that's been retained in the business entity itself. Now, you'll remember that the commissioners issued PCG 2024-D2, which deals with income that's PSI that's been retained in an entity. Now, this is not a situation where the PSI rules applies to the taxpayer and you've got to attribute the entire income to the individual, and you can't, and the entity is ignored. This is a situation where we satisfy the PSI tests. So there's no income attribution automatically. But the commissioner nevertheless says in PCG 2024-D2 that you can't just leave a surplus sitting in the company. In those circumstances there, what you've actually got to do is you've actually got to be able to justify why you're leaving a surplus in there. His view, generally speaking, is that all of that should be stripped out as a dividend or some sort of other profit distribution to the individual, unless you can earmark it as working capital or unless you can earmark it for a future capital purchase, generally speaking.
Yeah, so that actually, Dominic's question is a good follow-up on that. It's like, what are some examples of, legit reasons to retain profit? So those two things.
So have a look at PCG 2024. Now that deals with PSI, but that nevertheless it's a good guidance from the commissioner on the things that he considers to be legit, like saying, oh, it's working capital, or it's there because not because, hey, I just want to leave the money in there for a rainy day, and I don't know what's going to happen. I've left it in there for a specific capital purchase or a specific renovation to my business premises. I've earmarked it. Here are the plans, by the way, Mr. Commissioner. So this is not just pie in the sky.
Yeah. All right. One question from Cassandra, because this is relating to the case study. So given that the retained profit is in KYC, which is the radiology practice, and they've got the 700K in there, and we said that it was for the purchases of purchasing equipment. Is there any issue with retaining it in KYC, given that CDAP is actually the service entity that also holds the equipment, or does it not matter?
Well, that's a very good question. Now, and thank you, Cassandra, for pointing that out. Now, in that particular circumstance there, what will probably likely happen is that down the track, there will be an intercompany loan between KYC and SCDAP. Okay. Now, it's no Div 7A issues there because intercompany loans Division 7A doesn't apply. So you would probably likely have a loan between KYC and SCDAP for future purchases of plant equipment.
Yeah. Excellent. That's what I thought too when I was reading the case study before today's event. I was like, ooh, it could be a gnarly one. Oh my God, there's too many questions. I think we'll take the rest on notice. Meng, this might be some ideas for future Master Nuggets with Meng sessions, but before we wrap up today, one key takeaway from you, Meng.
The one key takeaway is that number one, PCG 20214, which is the Commissioner's Guidelines on Allocation of Professional Firm Profits, is just that, a guideline for assessing risk. It is not the Commissioner saying automatically if you're in a red risk zone, Part 4A is going to apply to your arrangements. Also, The guideline is only applicable where the income generated from your professional services business is not PSI, but instead income from business structure.
Mm-hmm. Yeah. So lots of complications there. And I saw some people commenting earlier in the chat box that like everything they knew about PSI has been kind of turned on its head. So thanks, Mei. I don't know if you confused people more or gave further clarification.
I hope not.
Awesome. Thank you for that. And thanks everyone for tuning in today. Again, if you did enjoy today's session, Meng has a whole lot in his back catalog. We've got them all the way running up to like the end of the year, pretty much. So more Master Nuggets with Meng coming up, and we will take those questions on board. Thanks everyone as well for your comments in the chat too. Thanks. Oh, Meng, you can't see all the emojis, but you're getting lots of love hearts and claps. So you're getting a fan
fantastic.
club following. Fantastic. All right. Thanks, everyone. Thanks for tuning in and joining us on a Monday afternoon. And hope you have a great week. And we'll hopefully see you next time at our next Nuggets live event. Thank you. Bye.
Thanks, everybody. We'll see you later.